Well, welcome everybody to the second session of the Matt Maley Market Strategy. And, we got to sit at a very important time in the marketplace. And I've titled this session as, we're heading into hurricane season and you need to buy insurance. And of course, if you buy hurricane insurance down in Florida or anywhere down on the Gulf Coast or anywhere in the southeast of the United States, that thing's costs a lot of money. Right now, it doesn't cost much at all, but it is badly needed because, this is the time of year when the stock market tends to see significant disruptions. Everybody knows that the worst month of the year is the month of September. However, these downturns almost always start in the second half of August, and more importantly, they almost always bottom at some point in October. And in fact, the worst part of the sell-off tends to happen in October. It just bounces back by the end of the month, and it doesn't seem quite so bad on a monthly basis. But this is a situation right now where not only are we heading into this hurricane season, but we're also doing it in a situation where we just have so many things that could upset the apple cart. Whether it's the AI bubble that is starting to see some cracks, the bond bubble. In fact, we have a situation this week where Secretary of the Treasury Bessent is doing some things that some people view as a panic move. And in my opinion, it's certainly something that shows that the marketplace, it may not be broken, but it is definitely not in a good spot. We have situations with budget deficits around the globe. We have massive levels of debt that are going to be auctioned off, whether it be in the corporate market or in the sovereign debt market. And of course, was the situation on a geopolitical landscape that doesn't just involve what's going on in the Middle East, but also Eastern Europe with Russia and Ukraine, and in other places where we still wonder what may go on between China and Taiwan. Before we get into all these things, I just want to comment about my experience in the markets. You may have seen me on CNBC or Bloomberg TV or heard me on Bloomberg Radio or other outlets. But my background is one that is definitely much different and much more unique than most market strategists. I was an institutional trader for 25 years. I spent the first 15 years at Salomon Brothers, the next 10 years at Merrill Lynch. So a total of 25 years. Most strategists kind of focus on what should happen, whereas you learn as a trader, especially on an institutional side of things, in block trading, that you're more interested in what's really going to happen, not just over the next 2 or 3 years, but what's going to happen over the next 6 months, 3 months, or even the next few days. So that gives me a very unique vision of the investment world, and it's gotten me a very nice following. I also want to give you an idea of how I've been able to help people, especially at key turning points in the marketplace. I just want to give you some examples here of what we've been able to do. I mean, for instance, here's just a quote from what happened here just a couple of weeks ago, back in early July, when the stock market was roaring ahead. We'd seen this massive rally in the semiconductor stocks, where the SMH and the SOX semiconductor had both doubled in just a few months. And we said, hey, this is a situation where we have to be very, very careful. And this is the quote I talked about, how both Broadcom and Micron, and then Samsung as well overseas, had all reported great earnings, but we got to sell the news reaction. And that I felt was going to be something that caused a lot of problems, not just for the rest of the chip sector, but also of the technology sector overall. That's exactly how things played out. And I highlighted back in that time, look how the SOX semiconductor index, how it had flattened out, how it had formed a head and shoulders pattern, and that if it broke below the 12,000 level, it would break down. It would cause a lot of problems, and I was warning investors that could be the case. And that's exactly what happened because, the SOX semiconductor index fell over 20%, almost 30% before it bottomed out, and we were able to pick up that bottom as well. And, it was very good for individual stocks. I called out what Micron Technologies had a head and shoulders pattern. And of course, the stock fell over 30% after this, it broke that neckline. And same thing with Intel. I mean, remember, Intel was trading at $109. I was warning people, this stock's going a lot lower. And sure enough, it fell below. Once it fell below 100, it dropped back down well below 90, which turned out to be a great call as well. At the same time, we really turned very cautious on the Treasury market, just as it was turning down. This is something that, people have been talking about. The Fed might be a little bit more hawkish with the new chairman, with Kevin Warsh. But I was focusing on the massive amount of supply that was coming to the marketplace, whether it be on the government side, of course, which we knew was going to be a major problem, but also on the corporate side, and how they would compete for one another for only a finite amount of money that can be invested in this area. And then, of course, I also highlighted how these budget deficits around the globe, in China, in France, in England, in Germany, et cetera, all have issues. We're all weighing on their markets. In other words, it's not just inflation that is hurting these markets. And sure enough, this is what we talked about. The bond yields had moved back up, and they were at 4.5%. And everybody's saying, nope, don't worry about it. It's not going to move any higher. We're going to see a nice fallback. But, I highlighted what, these MACD crosses. Remember, this is a very important indicator of a change in trend. And I said, no, these things are going to go a lot higher, and they will probably break to new highs. And that's exactly what happened. So those people who are investing, whether it be TLT and Treasury ETFs or interest rate sensitive names in the stock market or the bond market itself, worked out beautifully. Another area where we made a very nice call in this summer was in the biotech sector. A lot of people on Wall Street have been turning bullish on the healthcare sector overall, something we had been bullish on for quite some time. But we also took the next step and got one of the subsectors or the subgroup of the healthcare sector and really concentrated on the IBB biotech ETF. As you can see, we talked about this in the Maley report back in late June. And then you can see here we did the same thing again on the IBB biotech ETF in early August. And just look what happened here. We saw that what was going on at the end of June, how the thing had possibly was breaking out. So we jumped on this group very, very quickly. And sure enough, we confirmed it a few days later when we got that positive MACD cross. Remember what a MACD chart is? That's something that shows a key turning point in a group. And even if it was jumping up to 187, so we got it when it was back down in the low 170s, and reiterated when it got up to 187. But we still kept pushing it. And sure enough, it ran all the way to 210. However, you can see down here that when the stock got overbought on its RSI chart, we said, hold off, let's back off. We didn't say sell it. We said, let's back off the group and let it come to us because it had gotten stretched. Well, sure enough, the group came down 7%, from that overbought level. And then we came back in at the beginning of August. And sure enough, it's rallied very strongly since then. Now, of course, part of this thing with Moderna has helped that as well. But the group has had a very strong run, making new highs. And this is the type of thing that we get these key turning points on both sides of the equation that really helped investors do well. These are the types of things that we really help investors, whether it be individual stocks in groups overall, or of course, on the market as a whole, and different asset classes, like we were able to do with the Treasury market earlier this summer. So where do we stand now? And that's what we really care about. One of the things that we have is, again, we're heading into this hurricane season, and everybody is fighting tooth and nail to make sure that that this market keeps going higher. I mean, I cannot believe how bullish everybody is on the marketplace. Yes, there are a few people, Jeremy Grantham or Ray Dalio, who are saying that we have some problems going on there that could create a big downturn. But the vast majority of people are bullish. And even though some of them try to say, hey, there's a lot of bears out there. Well, there's a few, but there's not that many. As we saw from Merrill Lynch, they put out, or it's actually the Bank of America, which owns Merrill Lynch, but the B of A bull bear indicator was at one of its very most extreme reading since 2021. And of course, we know what happened at the end of 2021. That was followed by a bear market in the S&P 500 when it fell 25% over the next 8 or 9 months, and the NASDAQ fell 30%. But one of the things that has us worried, of course, is what's going on with this AI situation. We see OpenAI is not making as much money as people thought, and even Anthropic. Some of they're saying they're running on a run rate that will be 65 billion if you annualize it. It's all very sketchy stuff. But what I'm looking at is on the technical side of things, is it how incredibly eerie and how incredibly similar to what we're seeing now as to what we saw back in 2000 when the internet bubble burst. We talked about this a little bit the last time, but it's really important to go over this. See how the SOX semiconductor index, and we use that rather than the SMH ETF, because the SMH didn't exist back then. But you can see how it got hit hard, fell over 20%, and then rebounded. Okay, it rebounded and retraced, 50 to 60%. In other words, Fibonacci 61.8% of that sell-off. And everybody said, "Hey, it's great. The market's everything's fine." The problem was that it lagged behind the S&P 500. The S&P 500 back in 2000, we're talking about 2000, it rallied to a new all-time high. But this did not. And the fact that it did not was a big warning signal for the market. Sure enough, it rolled back over and got clobbered and fell even more, fell another 27% from this level, not in total, but and overall it was a 35, 38% decline, and it signaled the end of the bull market. Now, and again, that key lower low after it may think here, that was a normal bounce. Here was a severe, moved into bear market territory, big bounce. Everybody thought everything was fine, but then we made a lower low. That signaled the end of the bear market, of the bull market. What are we seeing today? Okay, so here it is, same type of thing. Big sell-off, initial rally, just like we saw back in 2000. Then a much more significant one. It bottomed, saw a big rally back, a little more than half. On an intraday basis, it actually did get up to that 61.8% retracement, that Fibonacci level that we like to look at. And now it's starting to roll back over. And again, we cannot say, for sure that this is going to fail and it's going to fall out of bed and make a lower low. But my point is that with everybody jumping on the bandwagon, just like they did back in 2000, there are very serious reasons to consider that maybe that's not going to be the case, that we're going to see a repeat of what happened in 2000, and that this bubble is going to burst sooner rather than later. And again, we're heading into this time in the marketplace. It's a seasonality issue that is setting up perfectly. But the thing is, it's not just a seasonal issue. We have this underperformance, this divergence among the most important leadership group in the marketplace. The tech stocks are the most important leadership sector, but as a group, the semiconductor stocks have been the most important leadership group for 3 decades, or actually even longer than 3 decades. It's been taking place since long before the AI phenomenon took place. So this is something we have to be watching very, very closely. And this is something we'll be talking about in the Maley report on a regular basis. Okay, every day in our daily stuff, and of course, especially in our weekend pieces. But another situation, again, we've talked about this, and we wrote about this in the Maley report. I mean, back at the beginning of 2000, 1998 to 2001. See, at the beginning of 2000, the Kospi, South Korea's index, topped out 2 months before everything else did. And sure enough, the US market topped out later. And then it just kept going down, right? That was a great leading indicator. The same thing happened this time around. The Kospi topped out about a month and a half ago, or actually almost 2 months ago now. And sure enough, July is when the US market topped out. There was a lag there. But the fact of the matter is that the Kospi today is not acting all that well. Okay, it is yes, it's bouncing back, but its rebound has been just like the SOX semiconductor index. It seems really strong. Everybody's talking about, oh, it's back on its feet, but it's only retraced about 25% of its sell-off, just like it did here. So if it rolls back over again, we're going to have to be very, very careful. We're not there yet. I'm not sounding the alarm. I'm not saying bury your head in the sand, but we're going to talk about what you should be doing a little bit later, just because it is so cheap to buy some insurance right now, unlike it is to buy insurance in Florida if you own a house in Florida, or hurricane insurance. But okay, what else is going on? Okay, we just talked about what was going on in the bond market. I'm sorry. Oops. In the bond market, we're talking about the treasury market. And we'll go a little bit more into a little more detail on this. But see what's going on in the S&P 500 this year in the past 12 months. It made a nice high back in October, a higher high in January, a much higher high in May, and a relatively higher high again here in August. But one of the best indicators for the stock market, especially when it gets really expensive, especially when there's a lot of froth in it, is the high yield market. See this in October? It made an all-time high in October as well, but made a lower high. Now, it was only slightly lower high in January. But again, remember, here, higher high, lower high. But not only did it not make a much higher high on 2 occasions, it has made a series of significant lower highs. This is exactly what happened in the 2007 timeframe. It also happened in 2018, and it happened in 2016 as well. I'm sorry, in the middle of the decade, 2015. The S&P only dropped about 14% then, but it's still that's still a pretty good indicator that those who are buying things hand over fist are making a big mistake right now. At least in the stock market. And again, in 2018, the decline wasn't a full bear market, but it went down 19.8%. Over 3 months, right? And so we need to be careful here, especially because we're in a bubble this time around, okay? Just like we were in a debt bubble back in 2007, and just like we were in 2000 with the internet bubble back then. The other thing to mention is that people keep telling us that the market is not, we don't have to worry about it because it's really not that expensive. At 20 times earnings or 22 times earnings, that's the new normal. The thing is, people can do some funny things when they're talking about their earnings. I mean, one of the big problems we have right now is 70% of the earnings growth that everybody's talking about, and the earnings growth has been good, but 70% are two stocks, okay? Amazon and Google, right? And 70% of those gains are because they've been able to mark up their portfolios of their holdings of SpaceX, OpenAI, and Anthropic. Not because of their everyday running of the business, because of these one-time gains that they're allowed to put as earnings, right? Their earnings are fine, don't get me wrong, but they're nowhere near as good as people are saying that they are. And not only that, earnings were great at the beginning of the first half of 2000, and then they just fell off a cliff. Earnings were great in 2007 until they fell off a cliff, okay? I'm telling you right now, if you're looking for earnings to turn down in a big way before you sell, you're going to miss it. It's just like credit spreads. Credit spreads do not widen out until the stock market's already, or at least they don't widen out in a meaningful way until the stock market is down 15% or more. Right. So these indicators that you hear from the financial news, Wall Street Journal and such, they don't listen to that. Those are not leading indicators. They're lagging indicators, and watching them does not help you at all. Okay. So the situation right now is that we have a marketplace that is dependent on steroids. And the thing is that for a long time, people have been able to say, as long as the Fed says they're going to do something, or if the Treasury says they're going to do something, then everything's going to be fine. They don't even have to do it. They just have to say they're going to do it. And Trump has been the king of that, whether it be, taking off quotas, taking the whole tariff issue where he's changing. And then the same thing with the war, where he goes on and off about the war. But people aren't taking that anymore. They're not buying that anymore. Nobody thinks that, that he's going to attack in a major way. That's just not going to happen, especially before the election. He can say it until the cows come home. Not going to work. And now we have this week what's going on with Secretary Bessent, is that people are like, you're panicking. You're doing it, even if it's just for political reasons. You're doing this because the market can't handle things on its own. Right? Every time the market goes down, you do a QE program. Now you're doing something to buy back bonds because you're worried that interest rates are going to stay too high. You know how many people I've heard say that don't worry about this. There's nothing to worry about here, because all that's really happened is that interest rates have gone back to their normal levels. Okay, that may be true. I think interest rates are going to move even higher over time because we have a situation where these debt issues and these budget deficits are finally causing investors to insist on being paid more for the risks they're taking, the higher risks they're taking. So I think interest rates will still stay elevated. And when they do finally turn down, it'll be because the economy is falling into recession, and it'll be too late. Okay. But these people who try to say, well, it's just normal that interest rates have gone back to a normal level. Okay. Let's use that as the base case. That is not a good reason to own stocks, right? Because the stock market is not normal right now, right? They've normalized interest rates, great. Let's normalize the PE ratio, the valuations for the stock market. Right? As I showed you earlier, the stock market is trading at 3.8 times sales. That is by far the most expensive the stock market has ever been. You cannot fake sales. When they do PE ratios, they talk about, you can do charge-offs and write-offs and these things to manipulate your earnings to make them look better than they really are. But sales are sales. They're legal. They're allowed to do these things, to take these charges, but they disguise how expensive the market really is. When you look at sales are sales. If you fake your sales, you're going to jail. So they don't fake their sales, okay? And we're at 3 times, 8 times sales. That was way higher than we were in 2020, 2018, 2007, and 2000, okay? And 2022 for that matter. The last, how many bear markets we've had. And 2018, I guess technically wasn't a bear market, but it was a 19.8% decline. We have an expensive stock market, and so we're going to have to see a normalization of the stock market as well. The stock market is going to have to come down. The bubble is going to burst at some point. May not happen immediately, and that's why I'm not saying go to 50% cash and buy guns and butter. I'm not saying that. This bubble could go on for quite some time, and that's why what we'll talk about. We're saying people should buy insurance. Right, not sell everything and hide in the corner, right? But again, we need to get down to 17 times earnings, and that would still be at the high end of history. And I know AI's changed everything, but they always say that, and it never works out. Okay, ever. I heard it in 1987. I heard it in 1993. I heard it in 2000. I heard it in 2007. I heard it in 2020 and 2022. They were wrong every time. It's never different this time, okay? These valuations are very stretched, and when the piper needs to be paid, it's going to be ugly. And the reason it's going to be ugly is we have so much leverage in the system. I mean, it's not just the massive levels, record levels of margin debt. It's also there are now more ETFs than there are stocks. And you know how many of those are leveraged ETFs? Well, when that leverage has to be unwound, it all feeds on itself. The same thing with these zero-day expiration options. They're actually leveraged. Okay, they call it gamma. Positive gamma has helped the market move higher. Negative gamma will push it lower. I'm telling you, a big reason why the stock market has rallied, well, as much as it has. Yes, some of it has been because of everybody loves the fact that of AI, and the market should have rallied, but it rallied way more because number one, we start off in 2023, the Fed engaged in QE because we had a major banking crisis. The run on those banks was a much bigger problem and a much bigger threat to the system than anybody realized. They flooded the system with liquidity, and the market went up. They did the same thing during the dot-com bubble when they flooded the system with liquidity for several years so they could fix the Y2K problem. When all those computers were going to, in the beginning of 2000, they were going to think the 00 on their computer meant it was 1900. And they had to fix those computers so they all realized it was not 1900. The 00 meant 2000. There's a reason why you have to put all 4 digits in any computer thing nowadays. You can't. And in the old days, you just put 99. What year were you born? And if you put 65, you're born in 65, 75, 75. Now you put the full year in, because they don't want to have that problem again. That's the real reason we had a dot-com bubble. Okay, I'm telling you, that's what it was, and that's the real reason why AI has been able to be as big as it is. It would have been a nice bull market. I'm not saying that. But I'm telling you, this massive levels of steroids have helped it, and at some point, people are going to wake up to the fact that this is not real. And we're going to have to not just normalize interest rates, but we're going to have to normalize the stock market. So if we are and say, don't worry, 6%, people finally stop worrying about in the 1970s. Thank God, because that was ridiculous. Nobody cares about what your grandparents paid for their mortgage. I mean, if you're a family of 3, you and your spouse have 1 child, and then all of a sudden you have a second child, and you need a bigger place, and you want to buy a house, well, 6 months ago, you could get a mortgage for 6%. Now it's almost 7%. I can't afford that house anymore. I don't give it. You think they care that their grandparents had to pay 15% for their mortgage? That doesn't make any difference. That's just a waste. They finally seem to be starting to move away from that, but it doesn't matter. You're normalizing interest rates back up to the 4 to 5% range. I don't overstate it. 4 to 5% rates. That's what should be normal. That's great. But if that's what should be normal, we no longer have 0% interest rates. You can't have a market trading at 3.8 times sales and 22 times earnings. The stock market's going to have to normalize. Well, why hasn't it normalized yet? Why? because it never normalizes early on. Whenever you have this froth in the marketplace, it feeds on itself for a while. And all that leverage keeps building up and building up, but then the leverage works in the other direction at some point. 1987, 2000, 2007, 2018, 2020, 2022. I'm sorry to keep repeating those dates, but guess what happened then? The bond yields rose in a meaningful way over a significant period of time. The stock market didn't care for many months until it did. And then what happened? The markets got hit and got hit hard. Now, in some cases, they got hit and fell into a horrible bear market. And one time, a huge financial crisis. And you can argue that these bubbles aren't as big as the past ones. That doesn't matter. You don't have to have the biggest bubble in the world in history for it to have a significant problem on your investments or on the markets. Wake up, people. We need to be more careful on this stuff. Anyway, let's go back to some of these the things that we're looking at right now that we're going to be, I think, could be very helpful for investors in the coming weeks and coming months. Again, we do this in the Maley report. Not only do I write a piece every single day. All right, it's a short piece, very easy. Then I do a weekend piece, but I also have a Monday meeting, and we could just talk back and forth. I talk like this for half an hour or so, and then we go in and people can ask questions. Right? It doesn't get better than this. All right? I'm telling you. And you can ask anything you want. If I don't know the answer, I'll tell you I don't know the answer. I'm more than happy. More than happy to say that. But it's a good go. You can get back and forth and get some real feedback on what you're thinking about in the marketplace and what you're concerned about in the marketplace. Anyway, let's go back. That was that price of sales that we were talking about. Okay, let's look at some of the things going forward that we're going to be looking at very closely. Now, we're very worried about, not very worried. I step back. Everybody's very bullish on the financial stocks, and I understand why. But we're starting to get some weaker data out there. Weaker numbers on the employment report 2 weeks ago, weaker data on retail sales last week. Of course, Walmart reported today. That was a problem. Home Depot, Lowe's problem. Others did report good ones too. So I don't want to overstate this. But if the economy starts to slow, and you see the Citigroup, or it's called the Citi Economic Surprise Index, has fallen off a cliff, right? Now, I don't want to overstate this because that doesn't mean the data is turning down. It's that it's not beating expectations like it had. So again, I'm not trying to say, oh my God, this is falling off a cliff, so therefore the market's going to zero. Not at all, or the economy is going straight into recession. But we are looking at a situation where things are getting a little dicey, and we have had these great runs in these financial stocks. So for those who are traders and like to trade a little more actively, look at a stock like JPMorgan, and this is something we talk about all the time in the Maley report. Okay, we're breaking down below that trend channel, not the worst thing in the world, and it's getting very close to seeing its first lower low since really since back in March. So, again, it's not a major lower low, but but we're seeing this negative MACD cross. It's starting to grow. Remember, what the hell is a MACD? It's moving average convergence divergence. It's when a short-term moving average crosses below a longer-term moving average. That's negative. When that shorter-term moving average crosses above it, that's bullish, right? And so, but you can see that we had a bunch of head fakes in here, but never turned down in a meaningful way. Now it's starting to become a little bit more meaningful. Look what happened here, big sell-off. Look what happened here, big sell-off. Look what happened here. Go time and again. So this is getting a concern for me. And we're going to be talking about the individual stocks in our daily and weekend pieces in the next couple of weeks, because this is going to be a great opportunity. Some people, they might in the options market want to take advantage of that, or maybe in the with these leveraged ETFs, you can buy an inverse ETF or put options. But we're going to be talking about this, and like I said, my kind of expertise is finding these key turning points, and I think we're on the cusp of one now. I'm not ready yet to pull the trigger and say be very start making some negative bets, but I'm getting close to it, and it's something that we'll be talking about. Here's a situation that's taking place right now that we want to take advantage of. But I also wanted to talk about how well we did last year. This is what we did on silver and gold. This was June last year. Okay, very early June, and we see how silver broken out. This is from the Maley report. Okay, broken out in a very nice way, and we really pushed it. Okay, and it was gold and silver as well. Then in July, we reiterated it in the very early beginning of July. We talked about gold here. If it could push any further higher above 3,400, look at where it is now. It's going to be really bullish. Same thing on silver. We said if it breaks above 35, okay, 35, it's going to go for months. Very bullish development for the precious metal. And we talked about weeks and months, not just, it wasn't a short-term call at all. In fact, we wrote it all the way into January. And of course, this is what happened. Starting in June, where we turned bullish, silver rallied 240%. But see how it got overbought? This is the relative strength index right there, literally almost to the day. We said we got to back away from this trade. All right. So we've been, again, key turning points. That's what we focus on. That's how we help people make money. That's what we do with the Maley report. Okay. What are we looking at now? Now we have silver. We're looking at this. Look at this here with the 50-week moving average. Okay. The 50-week, see, I should have wrote weekly up here, but you can see I wrote it down here. This is the weekly chart. So this is the 50-week moving average. See how that was really good support for months and months and months, really pulled away from it. Then it came back down. It had a negative MACD cross, so that was negative, but now it's turning back up. So it broke below that key support level, and that's why it got hit real hard. Now it's bouncing back up. Remember how the rule is. Old support becomes new resistance. We're bumping up right against that level. We're also very close to a positive weekly MACD cross. Daily MACD crosses are compelling. Weekly ones are even more compelling. And we can see what happened here the last time we got a very compelling upward cross. Then we saw the downward cross. I'm not ready to pound the table yet, but this is looking very good. Gold, same thing. I am a little worried on a very short-term basis. You see how, but what a great setup. Couldn't get above its 50-day. See that 50-day, that yellow line, kept trying to break above it and couldn't do it, and finally broke below the 200-day moving average. Boom. And everybody in here is saying, forget about gold. I don't care about gold. Well, guess what? Remember what I talked about a few minutes ago when we were talking about the breakout of gold at 3,500? Well, it's still above 4,000. It's still higher than any other time except for right here in history, right? So it's still on a long-term chart making a much higher low, right? It built a beautiful base over a month and a half and then broke out of that base, broke above its 50-day moving average, and now it's testing the 200-day. Of course, that old support is now new resistance. Can it break out? The one thing, though, on a very short-term basis, I'm a little worried here. And again, we'll be talking about this and giving people ideas in the Maley report of which stocks that could do well. And, obviously there's some ETFs involved there, but I'm a little bit nervous that it may have to take a breather here and pull back a little bit and work off this overbought condition before it really takes off. Could we see this? That's usually what you see at the end of a big blow-off rally. This isn't a blow-off rally yet. So I'm thinking that this thing could take a breather here near term, but we'll see. And and again, I'm a trader, so I like to get those timing points. So we'll be talking about that. But again, right now I'm going to be holding off a little bit. But if and when it does take off, look at the gold miners. Okay, again, they're getting overbought, but see how they sold off. The yellow lines I used there because that was building a base. Okay, broke out, made a key higher high, and you see it's really taken off. But it's also getting overbought. The key thing is, if gold trades sideways, the gold miners underperform. You say, well, don't the gold miners just trade sideways? No. When gold goes down, gold miners go down. That makes sense. Gold miners trade sideways for not 1 day or 2 days, but I mean, over an extended period of time, they underperform. They underperform gold. But when gold rallies, it outperforms. So it's 2 out of 3 are losers. But the third one is good. And not only that, when gold breaks a key resistance level, it really outperforms. It takes off. So again, this is already telling us it's probably going to take off. But again, it's getting overbought. It would be great to see it come back down, test that 200-day moving average, or test that breakout level here, just above, but basically at $90. But be a little careful near term. But again, one of our specialties is these timing issues. You can't time the market. That's why and that's why you use technical analysis. And I'm telling you, all those billionaire hedge fund guys you've heard of, they all use technical analysis. Right? I'm not saying they use it above fundamental analysis. I'm just saying they use it because it tells you where the buyers and sellers are, and when the buyers and sellers have run out of ammunition. So the sellers are done, and so it's going to break out. The buyers are done, it's going to break down, etc. So this is really helpful there. Okay, what else are we looking at going forward here? Okay, we're going to be looking at the oil and gas. Again, another one. Now, I've been bullish in this, and so this has worked out really, really well for our subscribers. But you can see how the XOP, that's a broader one than the XLE. I like to use the XOP oil and gas ETF because the XLE is 40%, or maybe even 50%, two stocks, Chevron and Exxon. Now, Chevron and Exxon are great stocks. I've actually been touting those for years back when they were both yielding over 7%, and they've had great runs since then. But back when everybody hated oil, this was a couple of years ago. But here, this breakout here, this is such a great move because it breaks out above a trend channel, goes back, retests it, bounces off it, goes back and retests it again, bounces off it, and makes a higher high. This, even if you go back to here, this is a really good move. Now, the problem is it's testing its old high at the same time it's getting overbought. You see how it got overbought here and it pulled back. So what I'd love to see is see this thing pull back to, a little bit, and then really that'll allow it to break that high from April of this year, and then of course of August. But I'm not saying sell or make negative bets on the energy sector. What I'm saying is that this technical situation is great. Now, I do need to say on the geopolitical thing, we know that Trump wants to get oil prices down. So we need to be careful. But we also know that Iran is sticking it right in his eye. They're putting a finger right in his eye. The situation is such that they want him to lose. I mean, a lot of people, some people don't agree, but a lot of people believe that the real reason the Vietnam War ended is because Congress pulled the plug on the money. Well, what happens if he loses the election, the midterm elections? They're going to pull the plug on the war, and Iran's going to be in better shape than they already are. And their people may not be in very good shape, but from what we hear, I'm sure you've heard the same stories, that these leaders are getting offered gazillions of dollars just to, be good. And they're like, no, we're not doing that. Right. So Trump's he's very frustrated because he's used to being able to make a deal, and they're not looking for any kind of deal that he's interested in. And so the odds that it's becoming more and more evident that the odds that oil is going to drop in a significant way. Just a month ago, or a month and a half ago now, middle of June, everybody's saying, oh, oil, we're going to have a deal. The Strait of Hormuz is going to reopen. It'll take a while, but it'll be open. And then everything's going to be hunky-dory. That we know that's not going to be the case now. And if he does something really extreme, that'll be bad for the market. So, it puts export controls on. That'll be good for oil prices here in the U.S., but it won't be good. It won't be good for the global economy in any way, shape, or form. So we'll be very careful because there won't be enough oil for the rest of the globe. Okay, so this is another one. Again, we'll be talking about this, not just what level the XOP will become more attractive again, but the individual stocks in the energy sector. And we've got a lot of them that we really like here. And just another thing to mention here is that when I'm going back to silver and gold, see how the dollar's breaking down. I mention it here because it also has an impact on all commodities, including crude oil. It's broken well below its trend line now. It is made a key lower low because it tried to stabilize here, made a lower low. Again, it's getting oversold. So I wouldn't be surprised to see the dollar bounce back a little bit. But it is going to have to bounce back in a big way. And given what Secretary Bessent is doing, given what's going on in Japan, there is a lot of questions as to whether the dollar is going to be making a big comeback anytime soon. So that's bullish on hard assets, and that's bullish on gold, silver, copper, which has already had a great run, oil. We are a big player in hard assets, so big bull on hard assets. Okay, I've been rambling along here for a long time, but the last thing I'm going to do here is just talk about what we're going, back to that hurricane season situation. Okay, we have a hurricane season for those who live in Florida and Georgia and the Gulf, the states. You can't get hurricane insurance; it's too expensive, right? The VIX is trading right around 15, right? So buying, whether you want to buy VIX options, you can buy VIX calls, or if you want to buy index puts, it's just good insurance. And I'm telling you, when you move into hurricane season, unlike it is with the weather down south, you can't get cheap insurance. For your stock portfolio, you can. The stock market has doubled in the last couple of years. Why not take a little bit of money and buy some, can buy some long, some puts on the SPY or the QQQ that go out into late October or early November. It's very cheap, and if you don't have to use it, yes, that'll be money that's wasted. They wasted. It's money that you had spent, and it'll impact your return. Okay, great. So instead of being up 105% over the last 3 years, I'll be up 104.5%. Because if you buy options that are as cheap as they are now, you're not going to hedge your entire portfolio, but you can hedge yourself in a big way. I mean, I'm telling you, if the S&P goes down 15%, you're going to make hundreds of times on your money. And that's going to make up for a lot of those losses. More importantly, it'll give you some cash to when everybody else is panicking at the bottom. They always do. They always say, oh, I'm going to keep buying the dip. I'm going to keep buying the dip. Finally, at some point, they say, I can't take it anymore. Get me out. Hey, but you're the one who's going to have money on the sidelines, and you're going to be able to take advantage of it when everybody else is panicking. You'll be able to keep your head while others around you are losing theirs, as Rudyard Kipling said a long time ago. Well, I'm still not totally sure, but I got to tell you, the situation right now is looking very dicey, and I think it's very, very important that people look to buy some insurance right now, especially because we're heading into that key hurricane season. Thanks very much for joining us. For more information like this and more, it's available at themailreport.com. Click on the link in the description for a 10% discount, and please be sure to like and subscribe to see for more. Thanks very much.